Welcome back to the Investing on the Go podcast, brought to you by Fund Caliber. We're taking a closer look at the world of corporate bonds today, exploring how spreads, duration, and credit risk influence bond valuations.
Hello, I'm Darius McDermott from Fund Caliber. Today I'm delighted to be joined by one of my favourite fixed income fund managers, that's bonds, to the rest of you. Somebody I've known through multiple phases of his career, and we have long-standing been investors and supporters of his franchise. Thank you for joining us, Steve Snowden.
Thank you for having me.
Steve is the lead manager on the Artemis Corporate Bond Fund, amongst co-managing on a number of the other Artemis bond strategies. So look, you and I, Steve, we can talk about bonds all day long because we sort of, at least I speak most of your language fluently, but it does appear, given we're going to talk a little bit technical today, that an introduction to what some of this terminology is. And I think the one I'd like to start with is the word spread. So you and I would talk about spreads over this or over that. What does the spread mean, as basically as you can manage it, to explain to retail public, please?
Sure, I'll try my best. So theoretically, at least, and this is how the market operates, and we could go into a conversation later as things have changed a little bit. But theoretically, a credit spreads is the additional yield that you get for lending to a person or to a company over and above what you would get for lending to a government or a country. So, for example, you should expect a Tesco bond to give you a higher yield than a UK government gilt. And the difference between those two yields is the spread.
So if that Tesco bond had a 5-year maturity, and we will come to maturity next, you would want a spread over the 5-year gilt to be correct, to be worthwhile. Okay, so it's that sort of not risk-free, but it's the risk premium that you should expect over the government bond of a similar length of time. So then let's talk about spreads. That amount of money that you get paid for lending to that individual or company, known as the credit spread, is a part of the corporate bond overall pricing. Tell us what's happened with spreads and what a tight spread means to a general valuation of a bond, or indeed a bond market.
Sure. The corporate bond market, you could argue, has existed as far back as railway debentures in the mid-1800s, but it really only got going in the UK, for a proper diversified market in the 1990s, and very much so only fully really developed over the last 25 years. Now, credit spreads go up and down. So when they're large or high, that means the market is very nervous, usually during a period of economic stress. And whenever the spread is a small number or low or tight, as we call it, then that means people think the economy is strong and there's nothing to worry about. Right now, credit spreads are what we call tight, towards the expensive end of the valuation range. So roughly speaking, you're getting about 1% more in a corporate bond than you will do on an equivalent maturity gilt. The record sort of high has been close to over 500 basis points or 5% additional yield. The normal range is probably 1 to 1.5% more than the equivalent gilt. Credit spreads have been tighter in the past, but that has been pre-financial crisis, and credit spreads reset wider thereafter. Now, we can go on to what I think about the valuation, but as things stand, just optically, if you were to look at a chart of credit spreads, you would say they're at the expensive end of the trading range today.
So like other assets, I suppose, when there is that uncertainty and unease, either because of financial crisis or COVID or any other macro shock, for buying or for your case, lending to a bond issuer, you get paid more. And in times where market seems sanguine and the chance of that company going bust and not paying you back are lower, then that spread is less, and the value opportunity is there so less as well. So how do you then, in this expensive spread market, if you like, or where do you go to get your opportunities within credit today? Because this is a credit fund.
Yeah, so I think it's important just to point out that be you a corporate bond fund manager like myself or an equity fund manager, we're kind of both in the same camp at the moment. When credit spreads are tight, as they are today, the equity market is usually pretty well valued. And when credit spreads are wide, then equity markets have usually fallen quite dramatically. There's a very, very strong correlation between credit spreads and how strong or weak the equity market is. So I would say valuation opportunities, whether you look at corporate bonds or equities, are hard to find at the moment. So I don't think that is uniquely a corporate bond challenge. We have had at Artemis probably a contrarian view on the market this year. We have been arguing, despite credit spreads being at the tight end of the trading range, that they will continue to improve or tighten, and therefore make capital gain. That is exactly what we have seen this year. Why have we had that view? Is because the risk to lending to companies and to individuals has continued to reduce. There's two broad aspects to that. First of all, the corporate bond market is becoming having shorter duration. Now, to put that in plain English, that means the average maturity of a corporate bond has reduced quite dramatically over the last few years. Companies, when they're issuing new bonds today, are typically issuing in shorter maturity bonds, so maybe 5 years or 10-year maturity bonds. If you go back 10, 20 years ago, it was quite common for companies to borrow for 20 or 30 years. So there's less long-dated bonds around today than there used to be. So the market is shorter or has less average maturity. And it stands to common sense. The longer time period you lend money for, the greater the compensation you require, because there's more things that can go wrong over an extended period of time. So, that's why, you can get payday loans. Okay, the yield is very high, but, it's a very short time period. And then you get the very long-dated loans. Anyway, to cut a long story short, because the market is a lot shorter today, you should expect less compensation. So many market observers and commentators look at credit spreads today and say, oh, they're very tight compared to history, which is true. But we have never had the market with such a short average maturity as we've had today. So all things being equal, credit spreads should be the tightest they've ever been in history, and they're not. And I think a number of people have not fully appreciated that point. The other thing that's important to bear in mind is the credit risk that we are taking, lending to companies and to people, has continued to improve or reduce. Over time, company balance sheets are much less levered than they were 10, 15 years ago. The same is true for personal indebtedness. Personal indebtedness in the UK, for example, grew rapidly. People took on more and more credit card debt and mortgages, etc., personal loans up until the financial crisis. Ever since then, there's been a big reduction in personal indebtedness in the UK over the last 15 to 18 years. So we've got two important factors here. The credit risk is less. All things being equal, credit spreads should be the tightest they've ever been in history. Layer on the fact that we're lending for a shorter period of time. All things being equal, credit spreads should be the tightest they've ever been in history. Put the two of those together, and I would argue credit spreads are still cheap or still have room to improve. And I think the optical observation that people make is wrong and will continue to be wrong.
So just another piece of jargon there, a terminology, which we talked about, balance sheet and leverage. So let's just, as we're trying to do a bit of education as well as an update, an individual or a company's ability to pay your interest for lending to them, if they have more debt, they may come under calls to pay that debt elsewhere rather than paying you. So if they've got a stronger balance sheet or less debt, as a bond manager, you're more likely to get your coupon paid. Is that how you would describe it?
Absolutely correct. So the financial risk is much, it's a, just think of your own personal situation. So whenever my first mortgage, when I was, this will quite unusual to the modern generation, but I had my first mortgage at the age of 24. I think the average today is more like 35, but I got my first mortgage at the age of 24, a 95% loan to value mortgage. Yeah. Now, a 24-year-old on a 95% loan to value mortgage is much riskier than a 40-year-old on a 50% loan to value mortgage. So, we could think of it, I was a startup company with very high leverage. So I was a high risk when I was 24. But if you've been in your career 10, 15, 20 years, and you're only borrowing half the value of the house, from the bank's perspective, house prices can fall dramatically and they still won't take a loss on the loan or on the mortgage. Whereas if you've only got a 5% deposit, if housing market falls 10%, the loan's worth more than the house and the bank is in a poor credit recovery situation. So that's the way to think of companies, just the way you think of a mortgage. Basically, the loan to value on your house has fallen from probably 75% to 50%. That's the way to think of corporate balance sheets. Much, much more robust today than they have been.
So look, when I think about bonds, and I believe, again, I'm trying to keep this fairly simple, there are two risks that we have. We have discussed the credit risk, which is the amount of compensation that you might expect for lending to a company or an individual. The other risk then is the duration or the length of that loan, which is called the duration. If I loan to you for 5 years, the duration is 5. Maybe explain how that works in the context of a fund and what an average duration means. And then maybe just a little bit about the risk that comes with that duration and why one does increase or decrease it. And then we'll come to talk about what you've done in the fund.
Yeah, sure. So we use the phrase duration as it's basically a mathematical average of the sort of like what is the average maturity of the bond in your portfolio. So the bigger the number, the longer time period you've lent money for. Just like credit risk, the longer you lend money for, the more things that can go wrong. From a duration point of view or an interest rate risk point of view, as we should probably say, there's more chances of a adverse change in the interest rate environment the longer that you lend money for. So you should theoretically always see as upward, what we call an upward sloping yield curve. That means theoretically you should be paid more for lending for 30 years to the government than you should over 5 or 10 years. So the longer the maturity or the higher your duration, the more risk that you're taking. So you're taking the risk that inflation might increase unexpectedly over time. That pushes up interest rates or the Bank of England base rate. When that happens, that is typically bad for the bond market. That forces prices to fall to compensate you for a higher yield, to compensate for a higher inflation and a higher Bank of England base rate. So the bigger your duration number, the bigger your risk. If you look at the corporate bond market, if you go back 5 years ago, the duration or average maturity was 8.5 years. Today, it's about 5.5 years. So you can see there's been a dramatic reduction in duration, which means a dramatic reduction in risk. And that dramatic reduction in risk is twofold. It's both interest rate risk today is a lot less than it used to be. And also because you're lending to companies, the credit risk is a lot less than it used to be.
And that's at the index level, I guess, and touches on what you've said, is that the overall market's duration has shortened, and hence that duration risk by definition has shortened, which leads into your observation about the credit part of the bond not being as expensive as others might comment on.
Correct.
So without getting too technical, there's two ways you can change the duration of your fund. If you have a view on interest rates going up or down or inflation, whether that's in line with market or against, you can, if you want to lower duration, you can sell some 10-year bonds and buy some 3 years. And if you want to do the opposite, you could sell some 3-year bonds and buy some 20-year bonds based on your views. Then you can also use derivatives occasionally to alter that because you still like the bond. So you can change that profile of the overall maturity. What have you done in the last, say, 6-12 months, and why? And maybe this leads into a little bit of outlook as to how you see maybe the 6 months ahead. I won't hold you to any longer than 6 months.
This part of the conversation always becomes a bit more complicated because we have to discuss the political backdrop, and everybody will have their own views on whether the current government is doing a good or bad job, and everybody has their own view on economics. But what we have to reflect on is the market is the market, and the market is deciding in aggregate what all investors are thinking. So what we have seen over the last year is, despite the Bank of England cutting interest rates as inflation has continued to fall, as it was forecast to do, gilt yields have increased, particularly 10, 20 and 30-year gilts. Now, that is a little bit complicated for somebody who doesn't spend their day looking at bonds. Theoretically, as base rates come down, the gilt yield should also come down, but the reverse has happened. It's more complicated than that. So the curve is what you call steepened. So we've had the yields on 1, 2, 3 and 4-year bonds fall, and that's very much governed or driven by the fall in base rates at the Bank of England. But because people or the market or investors in aggregate have decided the UK is less creditworthy than it has been, people are nervous about lending to the UK government for 10, 20 and particularly 30 years. So you may have seen in the press over the last month or two, 30-year gilt yields have reached levels that were last seen back in 1998. So the government bond market has decided, irrespective of your politics, the market has decided that the risk to lending to the UK government has increased, and that certainly was not helped by the government's inability to pass welfare reform a couple of months ago.
And I think you're right, Stephen. Irrespective of your politics, we know what happened when Liz Truss was Prime Minister. She brought a budget and the gilt yields rose dramatically, and that ultimately cost her job. But in the last certainly 3 months, certainly throughout the summer, the gilt yield was at the 30-year gilts was at an even higher rate, showing, I think, to your point, that people are wanting higher compensation for loaning to the UK government for a long time, or the flip side is worried about the ability of governments to balance their budgets.
Correct, but I think we also need to put some balance into the conversation. What we have seen in the UK, where particularly long-dated bonds have risen considerably in yields, that's not simply a UK phenomenon. We have seen exactly the same thing in Japan, in the US and in Germany, all for slightly different reasons. But what is a global problem is that the developed world is struggling to live within its means. We are borrowing more money to pay for more government spending than we're raising in tax revenues, and ultimately that can't go on forever. The bond markets globally, including the UK, are signalling that. We should also, just for some balance as well, just say part of the reason for the sell-off or the yield being so attractive on long-dated bonds is that inflation has picked up a little bit. Wage inflation continues to be stronger than many would have forecast. That means inflation, while coming down over the longer term, is still being sticky on the way down. And that's what we've seen with the last Bank of England base rate cut when they cut to 4%. Although they cut base rates from 4.25% to 4%, it was the messaging that went around that cut was hinting towards the stickiness of inflation. So the Bank of England has been, probably signalling to the market that it's going to be less aggressive in cutting interest rates, which has fed through to what you call a steeper yield curve or higher yields on long dated bonds. So look, it's not it's not all down to a unpopular UK government. This is a global phenomenon that we have seen. That all said, I mean, in terms of what we are doing or how we are positioned or what we have done, we over the last 12 months or so, we have been running a curve steepening position, which basically means we're very underweight these long dated bonds, and that's been to a great benefit to the fund. We have, however, more recently moderated the that position because we're now at yield levels that we haven't seen since 1998. We have very attractive real yields at the long end. So what that means is you can buy a 30-year gilt, let's call it 5.6% at today's money, roughly that. Inflation is currently 3.8%. It will come down aggressively early next year. So right now you're looking at a real yield. That's the difference between the yield that you're earning and inflation of close to 2%. And that could easily be 3% this time next year. That's a very attractive way to protect your money against the ravages of inflation over a long period of time. So the inflation adjusted potential returns here at the minute are very attractive. And that's why we are certainly much less negative on the gilt market than we have been.
Okay, so look, I think we've done a reasonable job of trying to demystify some of the terminology that you and I speak about on maybe a day-to-day basis, and you with your colleagues, for our listeners. You're sitting at the nerve centre of the Artemis Fixed Income Department. I think you've said, and you correct me, I know if I'm wrong, but you've said that you don't think spreads are super expensive, given the other factors we've already touched on. That inflation you expect, I think, to come down. What then, and we are approaching, well, we're still in early October, but we're approaching the end of 2025. What sort of return might we expect from a sterling corporate bond? And let's just remind our listeners, that means it's got to be 80% in investment grade bonds, even if they're borrowed in other denominations, hedged back into sterling. What sort of return might we look for the 12 months ahead as we sit here in October?
This is my least favorite question because...
Well, that's why I like to finish with it.
So, because something always comes along that you can't expect. As a fund manager, it's great if you can predict the future, and very few of us do that successfully. I think your skill has to be how you react as the information set unfolds rapidly. But as things stand, as we look today, the yield on the corporate bond market is about 5.5%. So assuming nothing goes wrong, we should at least get that return, I would argue, over the next 12 months. I do believe that the concerns that the market has about the state of the UK public finances are, that's not new news. Everybody is aware of that. I think we could be towards peak concern there. There is room for the gilt market to improve next year, particularly as inflation starts to come down. I do believe credit spreads, unless the unexpected happens, have room to improve again. Both those things should lead to some degree of capital return as well. So I am not allowed to make a forecast. That's a regulatory requirement. But there is certainly the starting yield of 5.5% today, plus the potential for some capital gains, I think makes corporate bonds a interesting alternative to sitting on cash, particularly as base rates will continue to fall and we will get a lower and lower yield on cash as time goes on. Look, we're never going to be able to compete against Apple shares or Tesla shares or Nvidia shares or whatever equity that's or gold, which has obviously been very strong of late. But I do think for the risk that you're taking, you are looking at a very attractive return relative to cash and to inflation over the foreseeable future.
Stephen, thank you very much indeed. I thought that was a really interesting chat.
Thank you.
Stephen brings his considerable experience in investment-grade fixed interest to this fund. He combines his knowledge and understanding of the macroeconomic backdrop with his credit analysis and technical understanding of the bond market. He and his team have a strong process and a good track record investing in corporate bonds. To learn more about the Artemis Corporate Bond Fund, please visit fundcaliber.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts. Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on Fund Caliber's research methodology and are the opinion of Fund Caliber's research team only.